Hello, thank you for joining. I'm John Janarone here today with Matt Hansen, founder and managing partner of Financial Services Capital. He's going to talk to us about the platform that he's built. Matt, thanks for joining us.
Thanks, John. Thanks for having me. Happy to be here.
Thank you, Matt. So, what's the current state of the European financial system and why are we talking about it today?
So, dislocation, John, would be the one word answer to the question. But to expound on that, the European financial system has been through three huge events just in the past 10 years. And they've been through those events under a fractured policy environment because it's an assembly of member states. Unlike the US, which was able to have a singular voice in responding to the global financial crisis because it's one country with one regulator and one political class. The European financial system, on the other hand, has kind of stumbled from the global financial crisis, which morphed into a sovereign debt crisis, and now has bled into the COVID dislocation. And there isn't the same concerted policy response, and the European instinct to defer the inevitable and defer difficult decisions has really come to the fore. And you'll see that in how the two different sectors are valued.
Great. So, Matt, is there an opportunity to take advantage of that value differential?
So there is an opportunity to take advantage of the value differential. If you were to look at any of the American bellwethers like JP Morgan or Aon, I mean, JP Morgan, for example, traded somewhere in the mid-teens in 2009 and now is, close to like 140 or 50 or something. So it's been a pretty stratospheric increase. Same with Aon or AIG. But in Europe, you haven't seen that same type of recovery. It wasn't too long ago, I think September, when banks and insurers were at 33-year lows. So, 10 years on from the global financial crisis, there'd still not been much of a recovery. There's been a little bit of one, but they're still largely trading well below book value. And, there is value there, but you can't simply just buy the public equities because the balance sheets are so opaque. The multinational diaspora of subsidiaries is too underreported on. It's too difficult, I think, to get a clear view on exactly what you're buying. And for that reason, it's a bit of a false economy to think that you can simply buy the public equities of the European financial services companies. Now, if I'm a allocator and I manage a large pool of capital that I have to split between geographies and strategies and industries, I would be thinking, well, the last 18 months have been pretty phenomenal for me. The stock markets after the March crash, COVID crash, have risen pretty stratospherically high. And I think it's fair to say that it's difficult to see where they go from here. They're priced pretty perfectly in both America and Europe and in the developed world. And then when you look at credit, credit in the United States has tighter spreads. It has the tightest spreads we've seen since October of 2007, which is kind of worrying. And in Europe, the junk bond index trades at 3%, John. Junk bonds in Europe have an all-in yield of 3%. That doesn't sound like junk bond pricing to me. So where do you go? Where is the value in the next 3 to 5 years? I think you would naturally be led to this disparity in valuation between European financial services companies and US financial services companies. You'd be looking to Europe for value investing, and specifically in financial services, but you can't really just participate in it as a public shareholder.
So, you as a private equity investor, when you look at these financial services companies, is there a potential or an opportunity to make operational improvements, and what might those look like?
Yeah, there is tremendous opportunity to make operational improvements, specifically when you buy the unloved subsidiaries and divisions of these sprawling multinational platforms, whether it's in banking or insurance or asset management or consumer credit or payments. What you're doing is buying a non-core subsidiary or an extra jurisdictional subsidiary. And by extra jurisdictional, I mean, if you're a French bank and you have a subsidiary in the Netherlands, that is a non-core asset. If you're a German bank and you have a French subsidiary, that's a non-core asset. So if you look at this patchwork quilt of Europe, there's lots of stranded non-core subsidiaries and divisions that are available for purchase. And, you know, as a private equity, operationally focused, sector specific investor, you can drive an agenda when you acquire these subsidiaries in a way that a generalist or a mutual fund or an indexed fund couldn't drive an agenda at any of these large multinational public company behemoths. So, as a focused investor with 220 years of operational excellence to bring to bear on the middle market, and I think most differentiatingly, a suite of enabling technologies and a capability with technologies that puts us in a class of our own, I think we're uniquely positioned to take advantage of this bastion of value investing that is left in the world. But you have to do it with a focused ownership. You have to do it in a private equity style where you can drive a transformative agenda. That's the way to capitalize on this unique value creation opportunity.
Well, can we talk in a little bit more detail about some of these opportunities? And tell me this, Matt, how open are the institutions themselves to you unlocking this value?
So I would say that the institutions themselves, the multinational corporates, they've been dragging their feet since the global financial crisis. And that foot dragging has not solved any problems. It certainly deferred a lot of difficult decisions. But now with COVID, the taxpayer in recent memory has had to stand into the breach, first in the global financial crisis, then in the sovereign debt crisis, now in the COVID crisis, to support these national champion financial services companies. And as a result, the taxpayers elect politicians, the politicians appoint regulators. They have no interest in hearing about these world, beating ambitions and these multinational aspirations. They want their domestic flag carriers to focus on their own backyard. They have no interest in their flag planning that they have embarked on for the 30 years prior to the global financial crisis. And what we're seeing the start of is a great unwinding of that flag planning.
Very interesting, Matt. So tell me, there are a lot of other private equity firms out there. You yourself worked at Cerberus for years. Why can't those very accomplished funds go out and do the same thing?
Well, they can, and large PE houses do, whether it's my old firm Cerberus or the Apollos of the world, and they've had a very successful track record of creating value, especially at the operational level in financial services businesses in Europe. But over the past decades, these funds have gotten enormous. They've sized out of the middle market upon which the stellar track records have been built. And furthermore, large generalist private equity firms haven't built an enabling technology vertical specific to any of the 100 sectors in which they invest. As a generalist, you can't have a suite of and facility with enabling technologies that's specific to any of the single, of the 100 sectors that you invest in. You kind of have to pick one. And it's not going to be financial services. Financial services is a highly specific sector that requires a highly specific technology solution. So they've been sized out of the middle market on the first hand, and then a generalist approach is not the best approach for financial services in the middle market.
That makes sense, Matt. But I've got to ask myself, there must be some competition, right? Are you joining an auction and bidding for these assets? How does that all look?
Yeah, look, you can't say there's never any competition, but I can say we don't participate in processes. If there is competition, we don't have an appetite to participate, and part of that is bandwidth constraint. But in reality, given the fact that our team has been operating in financial services in Europe as operators for over 200 years, and we've developed relationships with the regulators over that time period. We've developed relationships through our participation in industry bodies, and we've developed relationships with the C-suite of all of the large financial services firms in Europe. We don't need to participate in processes, and we won't do it. We drink water straight from the source, if you will. And that combination of operational talent, technology enablement, and industry focus has allowed us to do what I think is private equity 3.0.
That's a really interesting term moniker, Matt. You've been in the private equity business a long time. Can you give me a little history? What were 1.0 and 2.0 like?
Yeah, I've been in private equity quite a while, well over 20 years at this point. And I've lived through all of the evolution of the space. My first job in private equity was at Madison Dearborn Partners, based in Chicago. I also helped them open up a London office, but they were the grandfathers, if you will, of the asset class. My former boss there, if you looked on his LinkedIn profile, he's been at the same firm for 38 years. So private equity was a novel concept at a point in time where you could get together a group of private capital to take a company private or make a private control investment, and affecting the transaction and using leverage was novel. And that was private equity 1.0. Private equity 2.0 is, yes, you need to do that and do it with a value orientation, but you need to create value at an operational level. As an owner, you need to be able to make these businesses that you buy more valuable through operational improvement. And that encapsulates Cerberus and their philosophy and mentality and what they're good at. What neither of those had embedded into it is unlocked by sector specialization. And that is a suite of enabling technologies, a facility with technologies, a know-how with technology specific to a sector, specific to a geography, so that not only can you affect the transaction in 1.0, not only are you have a group of operators with 220 years of operational excellence that can deliver operating improvements, but you also have a facility with and a toolkit of technology. And if you use the technology wisely and correctly and discreetly, on idiosyncratic middle market assets, what you're able to do is compress, 20, 30 years sometimes of technology enabled value creation into one private equity hold period. So the European financial services space is littered with very, very dated, I would say, legacy infrastructure. 78% of the programming is done in COBOL, for example, which is a dead programming language. So with a focused investor and an investor that understands the operations of the business, an investor that understands how to modernize the infrastructure and technology therein, you're able to get a multiple of money that was heretofore unavailable, which is intrinsic to our strategy.
Great. So, Matt, you've laid out in wonderful detail the ability to make operational improvements, to buy at the right price, but of course, there's a missing piece. What's your philosophy towards exits?
So we have two mantras here at FSC. The first is buy foreign, sell local. And the second is buy on book, sell on earnings. And let me extrapolate. Buy foreign, sell local. That means that if you're buying the Dutch subsidiary of a French bank, the Spanish subsidiary of a German bank, you're buying from a foreign owner. And then when you improve that asset, when you modernize the technology, when you use all of the tools that we know how to use, whether it's cloud-based core banking software or big data and algorithms and AI for credit decisioning and monitoring and servicing, you're able to get an earnings growth trajectory, even with flat revenue. And that allows you to sell on a multiple of growing earnings. So you've bought from a foreigner and you sell to a local. And in my example, if you were to buy the Dutch subsidiary of a French bank, the local buyers would be, there's a lot of national champions: ING, ABN AMRO, Rabobank, NN Insurance, et cetera. And what the national champs that we would be selling to, and really any country in Europe, what they've been unable to do is tell the public equity investors and research analysts what their earnings growth story is. You have some pretty unusual things like Commerzbank in the recent past announcing that their target return on equity was 5% to be achieved in X number of years. That's not super captivating, let's say. So they need to buy in an earnings growth story. And they also need to buy in an answer to the question that they continually get asked, which is, what is your technology evolution strategy? And by buying foreign, improving it, reinvigorating the technology, and then selling to any of these national champions, you allow them to answer both of those two questions. What is your earnings growth story, and what is your technology story?
Great. Quick question. What does the time horizon look like in the exits? Is this traditional? Is this a traditional time horizon like in private equity generally?
Yeah, so I'd say that in general, financial services investments made by private equity houses have taken longer to realize than widget manufacturers. But if in 2.0 through brute force, you could affect operational improvement and capture it in 4 to 6 years. With the utilization of technology, I think you can both pull forward that improvement and pull forward those cash flows so that you're seeing it manifest in the cash flows and valuation of the company in 3-4 years, which allows you to exit, in year 5, which is, a couple years sooner than you'd be able to without the use of technology.
Matt, I've got one last question for you. Something that's really jumped out at me in our conversation is this shift in regulators' view on technology and how it's employed at these financial institutions. What's changed about it over the last few years, and what kind of implications does that have for you as a private equity investor?
You're right, John. Underpinning all of it, underpinning our strategy in its entirety, has been this dramatic sea change in regulatory perspective on financial services. It wasn't that long ago that every regulator in Europe wanted to be able to point at a terrestrial server physically in their jurisdiction and be able to say, that's where the processing occurs. That's where the data is held. And they've moved beyond that. And I have to give credit where some credit is due to fintechs, even though I hate the word fintech and I think it's an overvalued space. They did break down the barricades that had been put up around cloud computing, cloud data warehousing, the use of AI and big data for credit decisioning and analytics and monitoring. But they, keep in mind, for all the attention that these fintechs get, they represent a fraction of a sliver of the asset base in Europe when you compare it to the incumbent asset management companies and banks and insurers who represent, well over 90% of the asset base in Europe. I think the fintechs are very richly valued. And we're not a venture investor. We can't, or I just don't have the constitution to put principal at risk. I'm a deep value investor, so I don't swim in those waters. But the regulatory change in perspective has been driven by a lot of these new entrants, and they've come a long way. Our strategy of the utilization of technology buttressed by operational improvement, that technology piece wouldn't have been possible even 3-4 years ago. It's only been possible given any country and regulators in Europe in the past couple years, which is no accident that FSC was started after this regulatory sea change had taken place, because that change in regulatory perspective is the precondition for the effectiveness of a platform that's centered around technology and operational value creation as a focused private equity owner. And it's gone so far that the ECB even recently published a white paper encouraging financial services companies in Europe to utilize technology to reduce intractable cost structures, which sounds totally logical to you and I. But take a step back. You have a political and regulatory class telling companies to employ less people by using technology. I've never seen anything like it before. So we could have only built this platform when we did. And combining those elements of operational value creation, focused private equity ownership, and technology enablement, it's that combination of abilities and this confluence of events, both valuation and regulatorily, that's opened the door for what I believe to be the greatest risk-adjusted value creation opportunity in the developed world in my lifetime. Thanks, John.
Thank you very much, Matt. That's Matt Hansen, founder, managing partner, Financial Services Capital. Thank you, Matt.
All right, thanks.